What's going on, guys, and welcome back to my channel. Today I'm going to be talking about my $10,000 M1 Finance portfolio. I opened up this portfolio on June 6th, 2019, so it's only been around for a few weeks now. Currently I'm down $10 and that's negative 0.21%, but I won't be talking about performance in this video because it's so brand new. In this video, I'm going to be talking about why I created this portfolio and what this portfolio consists of. So I created this portfolio for long-term investments. This is not a retirement account, however. This is not a 401k, and this is not a Roth IRA. The reason why I didn't invest in a retirement account is because I didn't want to be limited by only being able to pull out my money at a certain age. And I understand all of the tax benefits that come with owning a retirement account, but to me, that wasn't enough for me to be persuaded to do so. I don't mind paying taxes, and for the most part, I want to have that flexibility. Sometime in the next maybe 10 years, something might come up where I want to take my money out and invest somewhere else, or maybe buy a house, etc. I don't plan on taking this money out soon. Like I said, this is my long-term investment account, and therefore a lot of the holdings tend to be kind of safe and something that I thought a lot about. So why don't we go ahead and take a look at funding first of all. So currently I deposit about $20 every single weekday into this portfolio. Very simple. I prefer to deposit daily rather than weekly because I want to take full advantage of dollar cost averaging. And if we take a look at my activity tab, you'll see that a lot of the money that I have in this portfolio actually came 8 to 9 days ago. So that's about $9,000 coming in 8 to 9 days ago. And so this portfolio, the allocation and the funding isn't really representative of it being around since June 6th, since like I said, a lot of it came recently. But let's not really be focused on that too much. Let's go ahead and take a look at what my portfolio is. So I have two slices in here. I have one called Dividend Growth and another one called Monthly High Dividend. So the one in dividend growth consists of stocks that all increase their dividends, as the name sounds. And then this monthly high dividend is stocks that pay a very high dividend and they pay out every single month. So let's go ahead and take a look at my dividend growth slice. What I'll even do is show this performance view that you can find on M1 Finance, which I think is really nice. So this is my portfolio, as I mentioned. This is drag. And by the way, the reason why it's called drag is because I think in the event of any kind of market condition, this portfolio will just keep on dragging forward, keep on moving forward, etc. And I definitely wanted to build something that was robust. So let's take a look at the dividend growth slice. So over the past 5 years, this pie would have returned 52.83%. The dividend yield is 2.874%, and I have about 20 holdings in here. So it's a pretty lean portfolio. This number is actually misleading. It should be higher than this, but the reason why it's at 52 and not something higher is because this performance by M1 Finance doesn't take dividends into account or dividend reinvestments. And obviously with this account, I intend to reinvest every single dividend that I earn. So like I said, this number should actually be a little bit higher. So let's go ahead and take a look at some of these holdings. Like I said, I have about 20 holdings, and I thought about each of these companies for a while before I decided to actually put it in my portfolio. And you'll notice that I would say maybe 6 of these companies are actually CPG. So CPG stands for Consumer Packaged Goods, and that's basically like household products and things like that. So those CPG companies are Clorox, Coca-Cola, Colgate, Kimberly-Clark, Pepsi, and Procter & Gamble. These are all consumer packaged goods. I think CPG is definitely hit or miss. There are some CPG companies that are doing not so well lately. Things like Kraft Heinz have been taking a hit lately. And even stocks like Kellogg's haven't been doing so well either. So this is Kraft Heinz. As you guys can see, they were about $96 a share here in February 17th, 2017, but they're not doing so well right now. So like I said, the reason why CPG can sometimes be hit or miss is because It's definitely really dependent on brand strength. So, for example, a lot of retailers out there like Walmart and Target are coming up with their own brands. Therefore, the need to actually shop for a specific brand can actually decrease. So there's definitely increased competition in some spaces more than others. So some CPG companies might actually take a hit because of that. But the companies that I've invested in this portfolio so far have not taken a bit of a hit, and I think going forward can also adapt to different climates, even things like the increasing amount of e-commerce in the near future. So I definitely felt a little bit more good about these than the other ones. And I won't talk about each of them individually. I'll mostly talk about this portfolio by industry, for example. So the next two stocks on the list are 3M and Caterpillar. These are both industrial stocks. 3M basically has four business segments. That's safety and industrial, transportation and electronics, healthcare, and consumer. About 60% of their revenue comes from outside the United States, so they're definitely diversified. And they're not as focused on just simply consumer as most people think. They do make a lot of products for commercial needs as well. 3M pays a 3.32% dividend yield, and over the past 5 years, they're actually down a bit. But one of the things that I like about 3M is, they have been around for a very long time, since 1902. They have been paying their dividends and increasing their dividends for over 50 years, which makes them a dividend king. And like I said, they're very diversified in at least four business segments. So I definitely like 3M. The next stock on the list is Caterpillar, and Caterpillar, like 3M, has also gone through a bit of a consolidation period. As you guys can see here on January 12th, they were at about $170 per share, currently at $133 per share. To me, that's considered a buying opportunity. So I went ahead and I invested some money in them, obviously. Caterpillar pays a 3.0% dividend yield, which is pretty solid. Caterpillar, what I really like about them is they are the world's largest manufacturer of heavy equipment, with approximately 16% of global market share in 2017. So I love to invest in companies that are industry leaders. Whenever I see the largest blank in blank space, I love to see that kind of thing. And it makes me feel confident as a dividend investor. The next few stocks that I want to talk about all have to do with retail space in some kind of way. So that's Costco, Home Depot, and Target. So let's go ahead and take a look at Home Depot first. So Home Depot, once again, is the world's largest home improvement specialty retailer, operating nearly 2,300 warehouse format stores, offering more than 30,000 products in store and 1 million products online in the United States, Canada, and Mexico. Now, what do I love about this first sentence so much? Number one, they are diversified across different countries. Just like 3M, they operate in multiple countries, like I said. Number two, they are a leading company in their own space. Like I said, they are the world's largest home improvement specialty retailer, and they have a lot of stores, nearly 2,300 warehouse format stores. The last thing that I really like is in today's day and age, when it comes to selling your own products, whether you're a retailer or a brand, to be able to sell online, I think is very important. So, Home Depot is no exception, and they're definitely adapting to that climate. Home Depot over the past 5 years is absolutely killing it. They are up 155%, and their dividend yield is 2.65%. So, obviously, I'm a fan of them. Next on the list is Costco. So Costco has about 762 stores worldwide, with most of their business coming from the United States. But they do have some business in Canada, even in Mexico and UK and Japan. So, like I said, I do like stores and retailers that operate in multiple countries. The other thing about Costco is most of their stores caters to individual shoppers, but roughly 20% of paid members carry business memberships. So whenever you have a retailer that can actually have a large subscriber base, it kind of ensures that people will come back and keep on shopping, and you create that brand loyalty that I love to see with retailers. Target also does a really good job of that, and we'll go ahead and talk about them right now. So Target over the past 5 years has gone up about 49%. They pay a 3.04% dividend yield. And So they do have 1,844 stores, but within these stores, the products that they offer is definitely very diverse. As you guys can see, these are pretty much all the major categories when it comes to home goods and CPG and things like that. The last thing I want to highlight is that 7% of their sales do come from e-commerce. So like I said, I do like to see online sales as far as retailers go. The next stock on the list is kind of a loner in that I only have one communication services company on this list, and that is Verizon Communications. So over the past 5 years, they've gone up about 17%, which isn't actually all that good. But what makes them enticing as an investment is that their dividend yield is 4.14%, which is pretty nice. The next two stocks I want to talk about are both in the finance space, and that's CINF, which is Cincinnati Financial Corporation, and that is Wells Fargo, which a lot more of you have probably heard of. But first, let's talk about CINF. So CINF over the past 5 years has gone up about 117%. That's definitely a lot, and you guys can see the size of this leg. Pretty much since July 2nd, 2018, they went from about $66 a share all the way up to $104 per share. So that's kind of like doubling themselves within the past year, which is pretty remarkable. They currently pay a 2.13% dividend yield, which they're actually not increasing all that much. If you guys can see, their last increase was a 3 cents per share increase, and then the same thing about the year before that. So they're not increasing all that much. I'm pretty much investing in them for the capital appreciation as well. What I really like about Cincinnati Financial Corp is that they do offer services to multiple types of customers. For example, they do have business with commercial lines, but they also sell to personal lines, and that's of course different types of loans and things like that. Things that pretty much have to do with insurance and financing. The last stock on the list of the financials is Wells Fargo. So Wells Fargo, as everybody knows, is a bank. Over the past 5 years, they're actually down. They're down 12%, but they do pay a really massive dividend yield of 3.89%, which I definitely like a lot. Their market cap is about 208 billion, so they are a massive bank. Wells Fargo, as you guys know, is one of the largest banks in the United States with approximately 1.9 trillion in assets. They are extremely diversified as a bank, in my opinion. So they do operate in three segments. That's community banking, wholesale banking, and wealth and investment management. And so a lot of that deals with credits and credit cards and deposit accounts and things like that. They also do operate in commercial real estate lending, pretty much what you would expect out of a bank, to be honest. But I did like them a little more than Bank of America, and that was mostly because of the dividend yield. And the last two stocks that I'm going to talk about in this dividend growth pie both have to do with the healthcare space, and that's Pfizer and Johnson & Johnson. So Johnson & Johnson pays a 2.66% dividend yield. Over the past 5 years, they've gone up about 35%. What's particularly great about Johnson & Johnson is, they are the largest and most diverse healthcare company, which I love to see. Johnson & Johnson operates in three different business segments, and that's pharmaceutical, medical devices, and diagnostics and consumer. What a lot of people don't realize is that 80% of their sales come from the drug and device group. A lot of people would consider them to be more of an over-the-counter type medication company, which in things like beauty and oral care, which does make up their consumer segment, but that only makes up a small part of their total revenue. So most of their business comes from large clients and pharmaceutical drugs and devices and things like that. Next, I want to talk about my monthly high dividend pie. So this account has gone up 21% over the past 5 years, but it pays a massive 6.91% dividend yield, and a lot of these dividends come every single month. So this is about 9 holdings, expense ratio of 0.47%. That mostly comes from the funds that I have, particularly SPHD and my two multi-asset bond funds. So I'll quickly go over the bonds together. So that's pretty much GOF and PTY. You guys can definitely read more up on them. GOF pays a massive dividend yield of about 10.72%. They are a very diversified investment company. And like I said, they do pay every single month of about 18 cents per share. The other stock on the list is ticker symbol PTY, which pays an 8.25% dividend yield over the past 5 years. has pretty much stayed flat, which I like to see. So the next two stocks on the list are actually owned by Gladstone. The first is ticker symbol GLAD, which is Capital Corporation, and the other one is Gladstone Investment Corporation, ticker symbol GAIN. So ticker symbol GLAD pays a 9.07% dividend yield. Over the past 5 years, it's actually gone down about 5%, but I consider that to be a good buying opportunity. Whenever I have a high dividend monthly payer, I really don't mind if it's flat. In fact, I would prefer flat with a 9% dividend yield than something that actually decreases in value um, and pays a higher dividend yield. So I'm totally fine with this one. This one is in financial services, more specifically asset management. You guys can read up more on what GLAD does. And then the other one is ticker symbol GAIN. This one is also in financial services and asset management. This one pays a 7.16% dividend yield. And over the past 5 years, they've actually gone up quite a bit. So it's almost like we're sacrificing a little bit less dividend yield for some more capital appreciation, which I definitely can't say no to. So I definitely like ticker symbol GAN a lot. Like I said, you guys can read up more on Gladstone. I think it's a little bit more boring to talk about. So yeah, I'm not going to talk about them in this video. This next one though, however, I did make a separate video on this one. This is ticker symbol SPHD. This is S&P 500's high dividend, low volatility fund. A lot of people, myself included, love this fund. It consists of high dividend stocks that have low volatility, and this one pays around a 4% dividend yield. What I love about this fund is it tracks the S&P 500, in a very low beta, low volatility sort of way. So you will most likely experience capital appreciation with SPHD. And because it is an ETF of about 50 companies, you can expect to be very diversified. And I do love those safer plays. So first, I'll talk about LTC, which is long-term care. So LTC pretty much is a active capital provider in the seniors housing and healthcare real estate industry. So if you're bullish on baby boomers retiring in the next 10 or 20 years, like I am, then LTC might be something of interest to you. So long-term care has gone up about 20% over the past 5 years, and their dividend yield is really nice at about 4.92%. So here in 2018 and late 2018, they paid about 19 cents per share, and only in 2016 did they actually increase their dividend yield. So pretty much over the past 5 years, they've only increased their dividend yield by about 2 cents per share. So if that's something that's going to bug you, then I don't recommend investing in them. But for me, I definitely don't mind that at all. The next stock on the list is Main Street Capital Corporation, which is actually pretty similar to the other Gladstone stocks that I talked about. Over the past 5 years, they've gone up a very healthy 30.22%, and they pay an awesome dividend yield of about 5.92%. So, pretty similar to the other Gladstone stocks. Like I said, they do work with equity financing and debt financing, so that basically means loans and investments. The next stock on the list prides itself on being a monthly dividend payer. This is Realty Income Corporation. A lot of people love this company. Realty has actually been killing it over the past 5 years. It's gone up about 62%, which didn't actually discourage me from investing in this company. And as some of you guys know, Realty Income does do a much better job of actually increasing the dividend every single year. And part of the reason why this dividend yield isn't actually more is because of how much the stock has gone up recently. So when the stock was about $49 per share, this dividend yield was closer to maybe 4 or 5%. I definitely remember that. So Realty Income is a REIT, as the name suggests. They own about 5,000 properties. Some are single tenant, some are multi-tenant, etc. So they are a diversified REIT. So the next stock on the list is Stag Industrial. Over the past 5 years, it's gone up about 28%, which is very healthy. They pay about a 4.62% dividend yield. And like Realty Income, they're also a REIT. But unlike Realty Income, their portfolio is definitely a lot different. So their portfolio is mostly comprised of warehouse and distribution buildings. So it's mostly commercial real estate that they're in. So just talking broadly about my portfolio, For the dividend growth slice, I give about 55%, and for the monthly high dividend slice, I give about 45%. And these allocation targets may change depending on the market climates. For example, if we go into correction mode, I might switch to the more aggressive route of investing in the dividend growth slices. But as far as just investing in any kind of market climate, I feel a little bit better about investing in the monthly high dividend stocks, mostly because those move sideways. So it's not like I'm averaging up all that much. And I really want to reserve a lot of the heavy investments for when there's actually good buying opportunities. As you guys can see, most of the stocks on my dividend growth slice are actually doing pretty well, but these tend to be the most volatile. So when there is a dip, like SPG is showing, for example, then I definitely want to take advantage of that. And like I said, for the majority of the time, I have no problem with investing in the high dividend payers that move sideways. So I'm sure this video has gotten very long. Thank you guys for sticking to the for the entirety of the video. Hopefully I can see you guys in the next one, and definitely let me know what you guys think of my portfolio. As always, I'm going to link the entire thing in the description down below, so you guys can check it out in your free time. All right, cool. So see you guys in the next one.